So hey guys, Josh Cantwell back again, and in this video, I want to answer a question that I get all the time, which is how do you get funding for big apartment deals? So it really comes down to two different sources of funding. You're going to have your first mortgage, your big sort of first commercial loan, whether it's bridge financing or Fannie Mae or Freddie Mac financing, permanent financing. When you get that first mortgage, it's going to be sourced through a commercial lender. The second bucket, the second source of funding is private investors. Big deals like this, multi-million-dollar apartment deals, are never funded no cash, like no money down. But they're always funded with typically a first mortgage with a Fannie Mae, a Freddie Mac lender, a bridge lender, and then they're funded through private investors. So let's talk about each one of these buckets for a minute. So when you look at this first mortgage, banks realize that when you buy a multi-million-dollar asset, that nobody really can just write a check for $60,000 a month to cover the mortgage payment out of their personal account. The building has to support the asset. When you look at a deal like this is already a stabilized deal. So what I love about it is that it's non-recourse funding. Now, what does non-recourse mean? Non-recourse simply means that I'm not personally signing for the loan. I'm not putting up my house or my personal assets. I'm not putting up my bank accounts, my stock portfolio, my real estate portfolio as a guarantee. We were able to show the lender that on day one, the property was going to cash flow enough to pay that first mortgage. So we went to a commercial lender. We used my friend Chris. My friend Chris is a big commercial lender, represents all kinds of banks and lending institutions. And Chris was able to broker our loan and work with it to get it closed through Freddie Mac. We bought the building for $3.745 million. We got a first mortgage of $3 million. That mortgage is, again, fully amortizing, 30-year loan, fixed for 10 years at 3.8%. So super low, amazing financing terms on the first mortgage. So what we do then is we say, okay, what's our shortfall? What do we need? What's the second bucket? How much more money do we need to put down in order to cover the purchase, the renovations, the soft costs, our acquisition fee, and any of those types of things? So we need a total of about $4.4 million. Now let's move over to the second bucket. So we used what's known as a private placement memorandum, also known as a 506B federal securities exemption. That allowed us to raise capital from people that we already had pre-existing relationships with. So over the last 15 years of me being in real estate, I've created amazing relationships with lots of different investors. And those investors now know us, like us, and trust us. They've invested in deals in the past. I went to them and said, hey, this is an awesome apartment opportunity. We're gonna pay you 10% interest, and we're gonna give you a 1% kicker when the property refinances. So 10% per year plus an additional 1%, which leaves their annualized return at about 10.5 to 11%. They'll be in the deal for about 2 years, then we'll refinance it, we'll increase the value, refinance it, pay all their money back, give them all their equity back, plus they've gotten the 10% return, and now they've also gotten refinance proceeds. So it's an amazing opportunity for them. We're all in for $4.4 million, and it's gonna be worth about $6.2 to $6.3 million. There's a lot of buffer there. There's a lot of safety and security there for them. And they decided, yes, Josh, I would like to invest in this deal instead of investing in the stock market, instead of investing in Bitcoin, instead of investing in oil and gas, cannabis, the stock market, bonds, mutual funds, all this different stuff they could do because they realized this stabilized building is generating enough income on day one to pay the first mortgage, Fannie Mae, Freddie Mac, and to pay our investors their preferred return for the next 2 years. So there's very little risk for them not to get their interest back. And again, we had to demonstrate to the first mortgage that we had experience, we had good credit, we've borrowed money in before and we've paid it back. So if you don't have those kind of things, but you have a good deal, you need to find what's called a co-guarantor or a co-sponsor or a KP, a key person who can help you sponsor that loan. okay? It's the best thing about multifamily deals, big multifamily deals, is that it's a team effort, it's a team game. Everybody works together to do different things. Somebody can sponsor the loan, somebody can raise the money, somebody else can find the deal, somebody else can do the improvements, somebody else can manage the asset. So in this case, if you need funding for a big deal and you don't have a big balance sheet, you don't have a big net worth, you can bring someone like me in or bring in somebody else to be a key person to sign on that loan for you. So those are the two buckets. Those are the two important pieces of how we get these big multifamily deals funded. If you want more information about how to get personal one-on-one coaching with me and my coaching team, go visit joshcantwellcoaching.com. There you can apply for a one-on-one spot in our coaching program. It's free to apply, it's free to learn more, and it's free to go through our 30-minute consultation. So check out joshcantwellcoaching.com.